Hello and welcome to the Project Finance Modeling course, and this is the first lecture, really an introduction to the course. And in today's lecture we'll be going over the toll road project finance modeling case study. Before we go over the case study instructions, I just wanted to show you the final model, the final product that will come from this course. And as you can see, it's going to be very detailed. We're going to model the construction costs and construction funding and revenue, operating costs, working capital, fixed assets, the tax, equity, the term loan to the project, including the sculpted debt service profile, the important project finance ratios, the debt service reserve account, the major maintenance reserve account, the revolver, shareholder loan, and finally we will do the valuation of the project. So we'll carry out the NPV and IRR analysis. So you can download and read the toll road project finance case study document. Here we're gonna go over this document briefly. And what case study says is that the government of Panama wants to build a new highway, and they want to attract private capital to do that. So it's going to be under build, own, transfer, concession project. And for those who are not familiar with project finance terms, please refer to the project finance theory lectures where we go over these items at length and in detail. So they want to do the build, own, transfer, concession project, and the investor, the private party, will have to construct the highway. They have to manage the highway for 30 years and then transfer back to the government after 30 years. And the private party shall recover its investment through charging the toll fee. It will be charging the toll fee, the vehicles that pass through the highway, and they will be charging this during the operation of this project. So the most important criteria to select the company that will be building this highway and then operating this highway for 30 years will be the toll fee. And you, as a financial analyst working at a company that wants to bid for this project, you're required to come up with this toll fee. You need to model this transaction, come up with the toll fees that result in the equity IRR of 15%. This is going to be a project finance transaction, meaning that majority of the construction costs will be financed with a loan from the banks. So you met with the lender, you got your indicative terms for the construction debt and for the term loan, and you also received proposals from EPC and O&M firms. So you know what's your capital cost and the operating cost is going to be for this project. You have the construction cost, which consists of the EPC items and other items given in the case study instruction, including the contingency of 10%. You have your construction debt, indicative term sheet, which includes the amount and the financing fees and including the interest during construction. So if we go to the model, we're going to be modeling this financing fees and financing costs during construction in our model, and then we're going to come up with total cost of the project, which consists of the construction costs and the financing fees. Then we're going to convert this construction debt to the term loan. So the term loan has to be repaid in 15 years, and the repayment profile has to be a sculpted repayment profile. And what it means, if we go to our model, so if you look at this chart, you can see that the debt service is following the CFATs. The CFATs are the blue bars and the debt service is orange bars. So the debt service is really closely following the CFATs. So when CFATs are high, the debt service is going to be high as well. And when CFATs are low, the debt service is going to be low. This type of profile is called sculpted debt profile. And we're going to be modeling the sculpted debt service profile in our model. You also have these minimum cover ratios that project needs to meet, and in the model we're going to be having those project finance cover ratios, making sure that they either equal to or larger than this minimum required. We will also be modeling the debt service reserve account. As you can see in the case study instructions, the lenders also provide the revolving credit facility, so we're going to include this in our model. The revenue assumptions, the operating costs, All these you can read yourself. I'm not going to repeat what is written here, otherwise I'm going to be wasting your time. And we have these fixed asset depreciation assumptions, including the maintenance capex, the dates and the amount, and the major maintenance reserve account that we shall be modeling, shall be having in our model as well. So you can see the debt service reserve account, the major maintenance reserve account, the revolving credit facility, and then taxes. And when it comes to the investment is, according to the case study instruction, is made in the form of equity to the company and the loans from shareholders to the company. The loan amount is 30 million with a 10% annual interest rate. So it's going to be junior to the term loan. If we go back to our model, we're going to be modeling the shareholder loan, and on financial statements you can see in the cash flow cascades the funds available for shareholder are junior to the term loan and the revolving credit facility. So those items have to be satisfied first, have to be paid first before the money goes to the to cover the shareholder interest payments and the principal repayments. And then model needs to be optimized. So the model needs to generate the IRR of 15%, and the minimum cover ratio has to be 1.4 as specified in the loan indicative terms. As we will be adjusting the toll fees to optimize the model, but the debt adjustments may also be required, so we'll have to meet the lender again and renegotiate the construction date commitment to the project, as the case study says. And we're going to be using a macro to optimize the model, so we're going to be using a simple and transparent VBA coding in the model to really automate this whole optimization process. That's all for today, and see you in the next lecture.